Welcome back to the deep dive. Today, we are really focusing in on the absolute bedrock of the modern tech world, and specifically the one company that seems indispensable to this huge artificial intelligence revolution, Taiwan Semiconductor Manufacturing, TSMC.
The
Yeah.
giant behind the scenes. Yeah.
Exactly. So our mission today, it's pretty straightforward. We've got these sources, financial reports, analyst notes, strategic briefings, and we want to quickly unpack what makes TSMC, well, frankly, the company set to win big from all this AI spending.
Right.
And the really interesting part, they seem poised to benefit no matter who actually wins the big AI contracts or, the GPU battles. They're like the arms dealer.
That's a good way to put it. And the scale of this market, I mean, we're talking about spending that's just hard to wrap your head around. Big tech firms, your Googles, Amazons, Metas, they're pouring hundreds of billions globally into building out these new AI data centers.
Billions with a B.
Hundreds of billions. And that money flows directly into silicon. GPUs, those custom AI chips, advanced networking stuff,
Yeah.
it all adds up. And if you need like a hook to grasp the sheer size of this, McKinsey has a projection. They think global spending just on the AI chips and the compute hardware for data centers
Yeah.
could go past $3 trillion
3 trillion. By when?
by 2030.
Wow. Okay. That's staggering.
It really is. And TSMC is basically positioned right there, collecting a toll on a huge chunk of that flow.
Okay, 3 trillion. That number sticks with you. So let's get into section 1, the titan behind the silicon. Why TSMC? Why are they the ones controlling this flow?
Right.
So for anyone who maybe knows the name but not exactly what they do, TSMC is the world's biggest semiconductor foundry, right?
That's correct. They manufacture chips based on designs from other companies. They don't really market their own branded chips.
So they take contract work from, well, pretty much everyone important. Nvidia, Apple, AMD.
All the big names. If you need the absolute cutting-edge silicon, you're almost certainly going through TSMC.
And their dominance, it's not just big, it's
Yeah.
concentrated, isn't it? The sources say they command something like
Over 70%.
70% of all chip manufacturing spending.
Yes. Globally. For the most advanced stuff, it's even higher.
Okay, 70% isn't just market leadership. That's, well, like you said, dominance. A chokehold, almost. So why? What gives them that edge the sources point to?
It really comes down to two main things. Their leading-edge process technology, getting down to those tiny nanometer scales, 3 nanometer, 2 nanometer,
Yeah.
and their advanced packaging capabilities, putting different chiplets together effectively.
Right. And why is that so critical specifically for AI?
That's the key question. AI hardware, especially things like NVIDIA's newest GPUs, their performance, but maybe even more importantly, their power efficiency,
Efficiency.
it's completely tied to that manufacturing process node. If you're building a data center costing billions, you absolutely need the best performance you can get for every watt of power you draw.
Because electricity costs are huge at that scale.
Exactly. And TSMC's leading nodes deliver that best performance per watt. Plus, if you need thousands of these chips to communicate seamlessly, you need that advanced packaging, like CoWoS.
CoWoS.
Chip on wafer on substrate. It's complex stuff, and TSMC is really the only one who can deliver that reliably at the massive scale needed right now.
So the advantage isn't just my chip runs faster, it's my chip uses less power, so my giant data center is cheaper to run, and I can fit more computing power in the same space.
Precisely. That makes them indispensable for anyone serious about competing in AI infrastructure. There just isn't really a viable alternative if you need the absolute best silicon today.
Okay, so that's the structural dominance. Let's move to the here and now, section 2. Analyzing the near-term surge. We're seeing recent financial data suggesting, well, a blowout third quarter is taking shape, right? Better than expected.
Yes, the signs are definitely there.
Yeah.
The August sales report in particular points towards pretty significant outperformance compared to their own guidance and analyst views.
Okay, let's break that down. What was the guidance for Q3 in U.S. dollars, roughly?
Their guidance was around $28.7 billion US for the third quarter.
$28.7 billion, got it.
Okay, now look at July and August sales combined. They already reported $21.85 billion US.
Just for the first 2 months of the quarter.
Just for July and August. Now, historically, those 2 months make up maybe 65% of the total quarter sales.
Okay.
But that $21.85 billion, it's already over 70% of their entire Q3 guidance.
Wow. So wait, they hit 70% of the target in just 2/3 of the time?
Essentially, yes.
The implication there seems pretty clear then. if September just comes in around the average of July and August.
They'll easily beat the guidance and likely beat current analyst consensus expectations, too. It shows things are accelerating faster than people thought.
Right, an acceleration story, what's
Yeah.
driving it? The sources mention a couple of things.
Yeah, two main drivers seem clear. First,
Right.
just stronger than expected demand for that leading-edge tech. We talked about the AI stuff.
Okay.
Second, on the consumer side, Apple is apparently ramping up production very aggressively for new chips, likely for the iPhone 17 launch. That puts huge demand on TSMC's capacity.
Makes sense. But these strong Q3 numbers, it's not all just pure demand, is it? There's some complexity. Geopolitics playing a role.
Absolutely. That's where it gets a bit tangled. The sources strongly suggest that worries about potential tariffs might have pulled some orders forward.
Pulled them from September into July and August.
That seems likely. Customers wanting to get orders in before any potential new tariffs hit, so that could be boosting these recent months a bit artificially, let's say.
And this links back to the whole U.S.-China dynamic, and specifically TSMC's dealings with the U.S. government. The Trump administration had threatened some really big tariffs.
Huge ones. 100% tariffs on semiconductors were floated. That would have been devastating for TSMC's business shipping to the U.S.
Right.
But the sources suggest TSMC managed to navigate that threat, basically by promising to build these big new manufacturing facilities, fabs, in Arizona.
Appeasing the U.S. government with onshore investment.
Exactly. By pledging to build in Arizona, they appear to have secured an exemption from those threatened tariffs, protecting their access to the massive U.S. market.
But that Arizona investment, it's not cheap, right? That's a strategic trade-off.
Oh, definitely. It's a classic example. They solve a political problem, secure U.S. demand, but the cost is significant. Building and running fabs in Arizona is much more expensive than in Taiwan. Labor, construction, everything costs more.
So it helps near-term certainty, but might drag on their famous gross margins down the line.
That's the potential downside, yes. It introduces an economic efficiency challenge, even as it solves a geopolitical one.
It's a constant balancing act. And speaking of tricky situations, there's also China. Nvidia tried to sell those modified AI chips, the H20 units, into China.
Right, after the initial export controls blocked their more powerful chips.
And the sources say Nvidia started making them, but then stopped.
Yeah, they apparently had to pull back again. The reports indicate the Chinese government basically discouraged local tech companies from buying the H20, pushing them towards homegrown alternatives instead.
So even for TSMC, who makes these chips for Nvidia, the geopolitical risks are very real, especially in the Chinese market.
They absolutely are.
Yeah.
But what's remarkable, and what the sources emphasize, is that even with that specific hiccup, NVIDIA's H20 sales halting in China, the overall global demand for the high-end AI chips that TSMC makes remains so incredibly strong.
It just overwhelms these regional issues.
It seems to, yes. The broader AI trend is just that powerful right now.
Okay, so Q3 looks strong, maybe boosted a bit by tariff timings, but the underlying demand is robust despite geopolitical friction. Let's pivot now. Let's talk long-term. Section 3, the long-term growth engine. If Q3 shows today's strength, what about tomorrow?
Right. The long view is really shaped by two things: their technology lead and their capital investment strategy. And maybe most importantly, their pricing power.
Okay, so what are the growth expectations, management's outlook?
Officially, management projects revenue to grow at a compound annual growth rate, KGR, of 20% per year.
20% a year for a company this huge.
Yes, from 2024 through 2029. It's an ambitious target.
Ambitious, but given everything we're seeing and what we're about to discuss on pricing. Could that 20% actually be, conservative? Do the sources hint at that?
They do. There's definitely analysis suggesting that given the sheer acceleration in AI demand and the fact that competitors aren't really catching up technologically at the leading edge, that 20% CAGR might be more of a floor than a ceiling.
A baseline.
It possibly doesn't fully factor in just how aggressively they might be able to raise prices, which seems to be their big strategic lever right now.
And this comes back to that R&D feedback loop, doesn't it? Having 70% market share means massive profits.
Tens of billions a year.
Which they pour back into R&D.
Right.
Which keeps them ahead on the next technology node.
Pushing to 2 nanometer, then 1.6 nanometer.
Which means anyone needing the best chips has to go to them, which generates more profit.
Exactly. It's a virtuous cycle for them, creating this ever-widening technological moat. Competitors are perpetually playing catch-up, often a full generation behind on the most critical nodes.
Leaving customers with basically no alternative for top performance, no matter the cost.
Pretty much.
Yeah.
If performance is paramount, which it is in AI, TSMC holds the cards.
Okay, let's quantify that power. The pricing details in the sources. This is where it gets really striking. The AI tax, as some might call it.
Yeah, this part is genuinely eye-opening. The reported pricing for their next generation 2-nanometer process node
Okay.
is supposedly set at $30,000 per wafer.
$30,000. How does that compare to now?
It's a 50% increase, 50,
Mm.
compared to their current top-tier 3-nanometer process.
50% in one generation. That's not inflation. That's demonstrating raw market power.
It absolutely is.
Does that 50% price hike just flow straight to their bottom line, or do the costs of building those new 2-nanometer fabs eat a lot of it?
Well, the capital expenditure is enormous. Building these next-gen fabs costs unbelievable amounts of money,
Yeah.
hundreds of billions over time. But this kind of pricing power ensures that even with those massive investments, their gross margins can remain incredibly strong. They're effectively making the entire AI industry fund their future R&D and expansion.
Passing the cost of innovation directly onto the customer because the customer has no choice.
That's essentially it. And it apparently doesn't stop at 2-nanometer.
Oh.
The sources suggest there's potential for another 50% price increase for the generation after that, the 1.6-nanometer process.
Another 50% on top of the first 50%?
That seems to be the expectation floating around. If that holds, you're looking at roughly a doubling in the cost for the most advanced wafers in just 2 tech generations.
That's TSMC basically setting the price floor for the entire future of high-performance computing and AI. It's incredible.
It really is. And it's not just the cutting edge either.
No.
They're also reportedly planning to raise prices on their older, more mature process nodes, the ones used for less demanding chips, by 5% to 10% in 2026.
So even on the older tech where you might expect more competition, they feel they have leverage.
It shows confidence across their entire portfolio. The financial takeaway is pretty clear. These price hikes allow them to maintain really high gross margins.
What are they now, roughly?
Currently around 57%, maybe a bit higher, which for a manufacturing industry this capital intensive is just phenomenal.
Yeah, that's huge. It ensures strong earnings growth even while they're spending billions on new fabs.
Exactly.
Okay, the picture painted by the sources seems almost too perfect. Is there significant risk discussed beyond the geopolitics we already touched on? What about customers eventually balking at these price hikes?
That's the main strategic risk highlighted, yes. At some point, does the price get so high that major customers think Google, Amazon, maybe Apple decide it's worth trying even harder to develop their own internal foundry capabilities, even if it means huge upfront losses and years of effort?
The make versus buy calculation shifts.
Potentially. But the technological barrier is just immense. Building a competitive fab at 2 millimeters or 1.6 nanometer is incredibly complex, costs hundreds of billions, and takes many years. Even for the biggest tech companies, it's a monumental challenge.
So the consensus is they might try, but catching up to TSMC's leading edge anytime soon is unlikely.
That seems to be the prevailing view in the sources. For this current wave of AI build-out, the window for a viable competitor at the absolute cutting edge might have already closed. TSMC's lead is too significant right now.
Okay, so connecting this back to the market view, the stock valuation.
Right. The sources note it trades around 26, maybe 27 times forward earnings expectations.
Which sounds reasonable. High.
Well, considering the kind of outperformance suggested by the recent numbers, the revenue surge, the strong margins, this unprecedented pricing power, if they actually hit that 20% or higher annual growth, then 26 times earnings could actually look like a relative bargain in hindsight, especially if they keep beating expectations quarter after quarter.
Right. So wrapping this up, the key takeaway for you, the listener, seems to be TSMC isn't just riding the AI wave. They are, in a very real sense, controlling the tide. They're structurally positioned to dictate the price and maybe even the pace of the fundamental technology that's driving this multi-trillion-dollar boom.
It's less about benefiting from the boom and more about being the gatekeeper to it.
Yeah, the gatekeeper, or the toll collector, as you said earlier, which leads us to that final provocative thought.
Right. Given everything we've discussed, the 70% plus market share, the massive R&D war chest constantly widening their tech lead, and this proven ability to hike prices by 50% generation over generation on their most critical products.
Yeah.
What realistic path is there for any competitor to truly catch up and break that dominance? Does Intel, does Samsung, does anyone have a credible shot at challenging them at the leading edge in the next, say, 5 to 10 years?
Or does the future of computing, the future of AI, effectively become dependent on the strategic decisions and pricing power of this one single company?
That's the fundamental question hanging over the entire industry. It's the structural challenge. that everyone from chip designers to cloud providers to governments has to grapple with going forward.